Okay, I have it going live right now, so it's going to pass on through Facebook and YouTube, and they're a little slower. So I don't know who is in the private room. Anyway, I'm going to hopefully have time to dice this video up eventually. So let's wait for some other people to get in here. And I can see a comment section using this program for YouTube and Facebook. So anybody who, I don't know if it's commenting or there's a chat side for you, whatever you can see. I'm not exactly sure, but you should be able to type questions in there as I go through, and I'll try to answer some of them. There might not be a lot of questions because I'm just going to kind of talk about what's happening in the banking system. Let's double check some things here on Facebook. I have no idea what it looks like on that end, as that's not really on my screen. All I see on my main screen is a software system for StreamYard. I have my computer over here. Let's go to, since I'm logged in as me, I don't know what it looks like. If I click on this link, let's see what it looks like. Oh, it looks like it's delayed over there. Watch live video. Interesting. I could see there are two people within. There's a private link that I had sent out for StreamYard, and that allows people to actually pop up on the screen and ask a question or whatnot. With Facebook and YouTube, all you can do is comment. And on my other screen here, the main software I'm using, I can see those comments come from Facebook or YouTube if there was a question on something. If you are using the StreamYard link, then I'll actually see you pop up on my screen, and it should tell you that at any moment I can click on you and it could go live. Like, if you get to choose whether your camera's on or not, but it can go live. So I might just click on you. You could ask your question. You could pop up on the screen. We could talk about whatever you asked. Depending on what the question is, there might not be many questions. Let's just wait for a few other people to get on in the private room I have here, and then whoever gets on Facebook and YouTube, get on. I'm going to probably cut this video up down the road and upload it onto YouTube, so people will still get to see it later. I know some people are going to respond that, it's too short notice. They don't have time. I was trying to set all this up earlier, but I just got back from South Lake Tahoe a couple hours ago. I did record a video this morning, but it was taking forever to upload. It's like almost 20-minute video. So I figured maybe I'll just try this live and see how it goes. Anyway, who's in, let me see. I'll use my private chat function. You guys can't see that. There's other people that pop up in here. The comment section. This should be pulling from either Facebook and or YouTube. So if you're watching from, let's say, Facebook, try to post a comment in the comment section real quick so I could see if it pops up over here on my other screen, because it's pulling from other software, and there should be a pretty good delay between what I see and what you're seeing from the Facebook or YouTube side. I see a like just popped up over here, but I don't see it coming up on the chat side. The comment side, I mean, from Facebook. Like, if someone posts a comment, I think I could actually click on it and it'll pop up on the screen. So if someone asked, is Chinese food good? I think I could click on it and it'll pop up on the screen here so everybody can kind of see what you're asking to. I just want to make sure I could see what people are asking. Okay, like Ben just said, okay, chat on Facebook here. So let me click on that. I can pop those up on the screen. So if you're on Facebook, I doubt we'll get many people on YouTube. They usually watch these later. It's probably gonna be Facebook and the private room. You guys can't see those questions, unfortunately, if you're watching from one of the other places in the StreamYard area. But if you're on Facebook or you're on YouTube, you can comment in the comments area and it'll pop up on a little screen here, and I could click on it like that and show what you're asking. But anyway, it's been a couple minutes, so let's go ahead and get started. Yeah, I've been saying comments show up on YouTube as well. Yeah, so this is exactly what it's going to look like on YouTube. Unless I cut something out. I don't know what I'm going to do. It might be too long. I might not even care. All right. So anyway, I want to talk about what's going on with these banks. I didn't expect so many people reaching out, asking what's going on. People like I wouldn't expect to be kind of caught up with what's going on, which made me think, from an investor standpoint, right? You're looking at, okay, what are people wearing? What phone is popular? Like, why would you invest in X stock, right? But when there's other things like, hey, I can't afford a house, or I couldn't get a loan, and you start hearing that from a bunch of people, you start wondering what's going on, what's causing that, right? So when I started getting texts and calls, and I'm hearing about it at church, and I'm thinking, man, this is making a lot more rounds than I would have thought it would. So I figured maybe I should just go ahead and talk about it, because some people are freaking out. And this week, I mean, who knows what's going to happen? And that's kind of what I'll talk about. But anyway, some of this might get technical, but it is important to know. And you'll know a heck of a lot more than your friends. Okay, but I'll try to keep it very basic. But there's a big danger right now in the banking industry. And just right up front, what I personally believe is that you're going to see this with smaller banks, mid-sized banks. This is like, I think there was an article that says the 16th largest bank. They're saying it was the largest bank since Lehman Brothers and all that, but it's really one of the only banks since then. So, I mean, it's just headline stuff to get you to read stuff. But anyway, I don't think we're going to see this quite yet with big banks. They have a lot of cash on hand. They can absorb this. So I know I'm going to get the question. There's a good question in here right now. How will this affect local credit unions? So I'll get to that. With bigger banks, they have a lot of cash and reserves with the Fed. So I wouldn't be as concerned with them initially. And I think we all learned from 2008, right? The too big to fail. Now, it doesn't mean that they're going to do that, but my assumption would be they're going to. And I mean, honestly, that's not a good thing. When they bail out these banks, they start to talk about how, oh, but if we didn't, then the whole banking system would have collapsed. Well, no, they go bankrupt and assets get sold and someone else takes over, And unfortunately, what we do need to happen, and this is across the world, any major developed country, the United States, we are the largest debtor nation in the world, right? We are, I guess, what you would call a bad credit risk, right? And when you hear your government talk about, well, we need to raise the debt ceiling so we could pay our bills. The reason we have to raise the debt ceiling is because we don't pay the bills. That's the problem. It would be like you raising your credit limit to make the next car payment or to pay your cell phone bill or whatever, your internet bill. That means you're not really paying your bills. You're trying to make it work by expanding your credit until one day you can't pay it back. And unfortunately, that's ultimately what's going to come just all across the world. Yeah, it's going to happen someday with the United States, but since the dollar is kind of the king of the world, everybody has to use the dollar to buy oil. Some of that's changing right now with China and Russia, and we'll see how that plays out. But really what's going on with this bank is when you deposit, this is really important. This shouldn't be the way that it is, but this is the way that it is. People don't know where money comes from. And I say money, but really I should say currency. We should all say currency because it's not money. It doesn't even meet the definition of money. We have a fiat currency, which means it's backed by nothing. It's just the government says, hey, you have to pay your taxes in this. You could pay debts and for goods and services with this, and poof, now it's money, right? It's currency is what it is. Money is something that can store value for a very, very long time. That's why gold has stood the test of time. 5,000 years. It's been money, right? It has to be fungible and divisible and all these, different characteristics of money. And eventually we were on the gold standard for a long time. Until 1971 we were completely removed from the gold standard, and I don't know that we're going back to a gold standard. I couldn't see government doing that. I mean, it's possible they're forced into that situation if we go to some major war or something, and if they need to stop the currency from collapsing, they can just revalue it. This happened over and over after 1933. I think the last one was in the 40s. Basically, the government just comes out one day and says, okay, an ounce of gold is now $10,000, which means if you had 100 grand sitting in the bank, and let's say gold's $2,000 today, you could have bought X amount of gold. But then when they come out and they revalue it like that, all of a sudden you could buy less, right? And just one day, it's over. They've done that over and over and over again. And it's possible that that happens again, and then they can put us right back on a gold standard. It's just you wouldn't be able to buy much gold at that point, right? This is why you're hearing a lot of investors talk about hold real assets, real estate, gold and silver, and just real things. But what's happening, and I think what you're going to continue to see with some of these banks, is you have a balance sheet with your bank or your company, right? And you have assets and liabilities on this balance sheet. So you have your asset side, you have your liability side, and with a balance sheet in the world of accounting, assets have to equal liabilities. And those liabilities include what might be called bank capital or bank equity or owner's equity. So those are liabilities because the company, right, is liable to those owners to pay X amount of cash or whatever. So like if you had $50,000 in liabilities that you owed somebody, or this company owed somebody, and then the company's owners put in 50,000. So on this side of that balance sheet, that's 100 grand, right? Well, the assets have to equal this side of that balance sheet. Okay. So there has to be $100,000 in assets. What you're seeing right now is the asset side of this bank. They don't do what's called mark to market with the bonds that they're holding right now. They can hold these to maturity. Okay, so if you have a bond, if you buy a U.S. Treasury, let's say a Treasury bond, and let's say it's $100,000, they're going to pay you 1% interest over 5 years or something, right? Well, this bank could put it on that balance sheet and say, hey, here's my asset of $100,000, because with a bond, it's a promise to pay you out by the U.S. government. I'm going to pay you $100,000. I'm going to pay you 1% interest every year for the time value of money, for waiting, basically. Okay. And they're supposed to be less risky and whatever, but we're going into a time when, you have to define what risky is, because if they paid it back in dollars, but the dollars are worthless, well, that's very risky. See, they're not looking at it that way. What they're talking about is risky in the sense that you don't get dollars back. Okay. They can print as many dollars as they want, so they can pay you back. The question is, what are you going to be able to buy with it? That's the real risk. But with those bonds, that $100,000 that's sitting on that bank's balance sheet, okay, they get to claim, hey, look, we have $100,000 in assets. Every single quarter that goes by, They, send out their financial reports. So, you can go buy their stock and see how this company's doing. But on their balance sheet, let's say what happened recently, the Fed started raising interest rates. So as they raise rates or cause rates to go up, you have to get a higher yield on that bond because people don't want to make 1%. So the government says, well, we'll put them out at 2%. Nah, they don't want them. 3%. Nah, inflation's 5. I don't care. I'm going to lose 2%. So eventually you find that number. Right now, I think even on a 2-year, I think it's 5% interest, which we haven't seen in quite some time. Well, here's the thing. As the interest rate goes up, when that bank bought that bond, the value of this bond goes down. Now it's still $100. This gets a little confusing because it's a promise to pay $100. But if they wanted to sell that to somebody on the market, right? You don't want to pay $100,000 for 1% because you can go to the market right now and get, $100,000 at 5%. Why would you touch that? So they have to discount the bond. So let's say they have to drop it down to $40,000. So once that is sold on the market, you decide, you know what? I'll buy your $100,000 for $40,000. And that sounds crazy to people, right? But you're also only going to get 1% when you could have bought something that got you 5. So that's that risk premium, right? Because you wouldn't buy that. It'd be dumb. You just go buy the new bond. Well, as long as that bond is sitting on their balance sheet, they get the claim it's worth $100,000 because they don't have to do what's called mark to market. So if the value of that bond falls down to, let's say, the equivalent of like $50,000, they don't have to show on their balance sheet that, oh, look, we're down $50,000. They don't have to report it that way. It shows up as $100,000, right? What happened, or I think the biggest problem is this: when you make a deposit into a bank account, okay, that's a liability for the bank because they owe you that money. Now, if you heard about Celsius, all that type of stuff that happened where, it's funny because people don't understand how this works. So they'll say, oh, these people had their money in Celsius, serves them right. They lost their money or whatever, right? But they don't realize their bank is exactly the same. When you deposit your money in that bank account, it's not yours anymore. The bank owns that money, currency, whatever. It's theirs, which means if they go bankrupt, you may not get that money back. They have to sell assets and all this type of stuff to see how much you're going to get back. And yes, there's the FDIC and all that, but you see what I mean. It's very similar to what happened with Celsius. Same concept. But here's the deal. You deposit, let's say, $100,000 into a bank. That's a liability for that bank. They have to have an asset to offset that. Well, the asset is they have your cash. So that goes onto the asset side, and it's, hey, we owe Johnny $100,000, right? Now that $100,000, they have options. They can lend it out. They can buy bonds. They can hold some, right? There used to be what was called a reserve requirement, and the Fed can change this at any time, and who knows, maybe they will. But a reserve requirement, this is where kind of like fractional reserve lending came. You put $100,000 in, that goes into vault cash, right? These are both considered reserves for the federal or for a bank. Vault cash and reserves held at the Federal Reserve. Okay. So if the Fed says banks are required to have a 10% reserve, then that means when you put your $100,000 in there, that bank has to give $10,000 to the Fed and it has to sit there. They can't lend it out. They can't do any of that. That's on reserve in case you come to pull some money out. And if enough people had put money in, right? Say 10 people put $100,000 in, well, technically they have 100,000 sitting in reserves, right? Because it's 10,000, 10,000, 10,000, 10,000 sitting in reserves. So if one of you shows up, they have enough money to cover that. They can pay that guy out and whew, we survive type of thing. That's with fractional reserve lending. After the financial crisis, the Fed got rid of that. There's not even a fractional reserve lending. It's zero. which leaves what's called excess reserves. Okay, there's a formula for this. It's for the money multiplier. It's 1 divided by R plus E, so reserves plus excess reserves. So a bank can decide what their excess is going to be. So you put your $100,000 in. They decide, well, we need to make money because a bank only makes money by lending it out. Okay, so they have to, let's say they decide, well, let's keep 10% aside in case we need to, people come in to pull cash out, and let's lend out $90,000. So when they do that, here's the crazy part. This is actually how your currency is created. It's not really by, I mean, there is some created by government when they issue bonds, and it goes through this process of primary dealers, and they're like bond dealers. The Fed buys from the bond dealer. The bond dealer had bought the treasury bond from the government, and poof, money exists. But the Fed had created that money out of thin air. Okay. And then it goes through the economy as the government spends it. But the idea is this: if you put your 100 grand in, they loan me 90,000, and I go buy Ben's house. So I give him that 90,000. What's he going to do? He deposits it. Well, now his bank can loan out, what would it be, $81,000, right, to somebody else. Who else is in here? This Mango Boy, whatever. But anyway, someone can loan that out too, and then it just keeps getting loaned out until it's zero. That's really what the money multiplier. That's how your money. Let me end this over here. That's how your money is really created, mostly through the banking system. Okay, so now there's really only $100,000 that of real cash, let's call it, that exists, but they could create $1 million in loans on top of that. So if everybody comes in, that money doesn't exist. That's how the money is created. But it gets deeper than that, because when that $100,000 is first deposited, it goes into vault cash. They decide how much they're going to keep in vault cash and reserves. Okay, so here's your liabilities, here's your assets. Let's say you have that 100 grand, they keep the 10%. Okay, they'll keep it on hand just in case. So that leaves 90,000. Then they take 40,000 and they lend it out. And then they're like, well, let's not lend it all out. We got to pay these depositors something though. So let's take this 50,000 that's left and let's go buy US treasuries, right? Because it's going to pay interest and we can give that to depositors, and it should be fairly safe. But here's the problem. When the Fed dropped interest rates down to basically zero, the bonds didn't really, really, it's just another way to hold an asset. It's not cash, but it's considered like a cash equivalent, right? So it pays very, very little interest. The problem is there's a duration on that bond. If it's a 5-year treasury, then it's, let's say, 0.5% over 5 years. So if they put $50,000 into a treasury that pays 0.5% each year over 5 years, and then all of a sudden the Federal Reserve raises interest rates, then that means new bonds that are coming out are 1%, 2%, 3%. They keep climbing and climbing and climbing. So all of a sudden you have that 5-year treasury at 5%, and this bank is holding 0.5% treasury at 5 years, and then you come in to pull your money out. See, this is very liquid, meaning they can get rid of these very quick. It's a huge, huge market for US treasuries, right? So they can sell them very easily. That's one of the reasons they buy them. But here's the problem. They have to sell it at a discount. And if rates are higher right now, nobody wants that 0.5% interest when they can get 5. So how far does it have to be discounted for you to say, yeah, I'll buy that, right? They still get to show $50,000 on their balance sheet. If they don't have to show an unrealized loss, remember, because it's not marked to market with these. They could hold to maturity. So until it matures 5 years later, right? So when they go to sell that on the market, it's, we need cash right now. Johnny came in to pull his cash out. We need it now. They have to liquidate. but nobody wants this. So maybe they pay $10,000 because it only pays 0.5%. So they're buying $90,000 for $10,000. That's probably not the real price, but that's how it would work, right? They discount the bond's value because nobody's going to buy it. So that's what's happening. And once it sells onto the market, now it's a realized loss. So all of a sudden, that 50,000 bucks, let's say it sold for $10,000, right? So once that sells on the asset side of their balance sheet, it sold for 10,000. They had 50 grand sitting in there. Now they show a $40,000 loss on this side of their balance sheet. So what happens over here? Now we don't balance, right? So you have, remember, on the liability side, you have your basic liabilities, like you deposited your money, the bank owes you that, and you also have the bank capital. So for a bank, the owners, it's like owner's equity with a company, right? So the owners, let's say they had $10,000 in this bank of their own money that was left. Well, when this takes a loss of 40,000, it first comes out of bank capital. It comes out of the owner's pocket. So $10,000 gets wiped out on this side, but there's still $30,000 less on the asset side. So you can't go negative 30,000 over here. So what does the bank do? Well, first, they're insolvent. They can't cover that position. There's a couple different things they could do. They could try to issue new stock, which apparently that's what they were trying to do, Silicon Valley Bank. They try to issue stock, but as soon as word gets out, oh my gosh, this place might be insolvent, everybody starts selling the stock. So nobody wants to buy it. So the price is going down. So they could try to issue bonds, but a bond would just be a loan. Do you want to loan them money? Do you think they're going to be able to pay you back? Well, no, you don't want to loan them money. Word on the street is they can't even pay back the people who deposited their money, right? So nobody's going to lend to them. They can go to another bank for overnight lending, repo market, something. They could try that. But when other banks hear that, same thing. It's like a bond. They're not going to want to lend them money because they're afraid, hey, I'm not going to get my money back. My depositor's money back. I can't lend you money. So one of the last resorts is the Fed, right? The Federal Reserve could come up with some sort of loan, bail them out, whatever. And that's kind of what's happening right now. We'll kind of see how it plays out. But Signature Bank just was taken over today, Sunday, because of the contagion. There's a couple other banks that are probably going to end up in that position. Key Bank is another one. And I work with Key Bank with some of my properties. So this is going to be interesting. We'll see what happens. But that's that basic balance sheet. Once it's marched to that market of, we have to realize this loss. There's only a couple things you can do. Then you're insolvent. The bank fails. It's over, right? And you have the depositors, they want their money back. They'll try to get it through the FDIC. And just understand, I think that on the last report, I'll have to look it up, but the FDIC only had like $170 billion, right? They can't cover everybody's deposits. And then they have to go through that whole finance trick to try to get more. I mean, where do they get their money? Well, from the government. Where's the government gets money? From the Fed. They have to issue these bonds. So it'd be this whole deal to try to get money to the FDIC. And someone in church brought this up the other day. I'll have to look into it, but something about the FDIC, yeah, they guarantee up to $250,000 for those depositors, but something about the 10% in the fine print, only 10% of that is actually guaranteed. I don't know. I wouldn't want to, in a massive banking crisis, you don't want to count on the FDIC, right? Because if all kinds of banks are failing, number one, it's probably going to take you a while to get your money. And number two, if everybody's waiting on that money and they've got to print it, is it even $250,000 in purchasing power and real value at that point? Probably not. You're going to have massive inflation, because inflation, just to define it for this talk, the true definition of inflation is expansion of the currency supply. It had been that way since before 1991, all back through history. It was the expanding of the money supply, not rising prices. rising prices was a lie that government came up with because they can control what they put in that basket to calculate the consumer price index. That's CPI, the number you hear all over the news about how, oh yeah, inflation's 2%. I mean, many of you, I'm sure you remember back in 2008, 2007, 6, all that. First off, home prices were exploding. Well, how come inflation didn't go up? Because they don't count that number in there, right? They can remove this type of stuff, and they've recalculated a bunch of different ways. So even when you hear on the news that, oh, inflation is the highest it's been in 40 years, I mean, technically it's higher because we're not even using the same calculation we used back in the 70s and up to 1981. We're not even using that same calculation. If you use that same calculation, it's higher than it was back then. So, I mean, it's sort of dishonest to even make that claim, right? But this is kind of how government gets away with it. I mean, I can't blame them in a way. You might as well be the biggest debtor in the world if you get to control the money supply. You just inflate your debt away. There's a great benefit to being a debtor in an inflationary environment. That's why the government, I mean, I can't figure out who's dumber. Everybody who loans us money, I mean, they give us real stuff and we send them pieces of paper, or not even that anymore. We send them these IOUs. It reminds me of Dumb and Dumber when they get that, was it the Lamborghini? And there's only IOUs left in that briefcase, and tells that guy, you might want to hold on to that one. It reminds me of that. That's what this is. So the rest of the world, someday, do they wake up and say, hey, they might not pay us back? And we just saw this with Russia, right? So we're in a weird situation. And this could be the beginning of a banking collapse. But again, I think this is you're going to hear a lot of names of banks that you've never heard of because they're going to be smaller. Let me stop real quick. I see there's other people in the room now. Some of you are in my StreamYard thing. So other people on Facebook don't even know you're here, or YouTube, they don't know you're here. If you're on Facebook, you can comment and it'll pop up on this little screen over here. I can actually click on it. Ben has a test one here. So I can actually click on it if you have a question and pop it up there. And then we have YouTube as well. So if you comment on YouTube, there's another one from YouTube, it'll pop up right there. So if you have questions, I know some people came late, so I probably already talked about it. I'll upload this on YouTube eventually, and you can also watch it back. But I'm trying not to keep it too long. But anyway, we're just kind of testing this system out. But back to what I was saying. It's possible Monday we see more banks fail. Some of it just due to panic. Some of them are over leveraged. I personally think this question right here from Mango Bay, how will this affect local credit unions? Here's the problem right now with credit unions. Well, first off, they're ran a little bit different, but a lot of these smaller banks, like your credit unions, made a lot of car loans, the smaller end level of these loans, right? And I don't know if you've seen this in the news. I think I was talking about probably, I don't even know, a year ago about what was going to happen with the auto market. A lot of subprime loans. That means they're people who don't have great credit, or they're barely going to be able to make their payment, but they give them this loan. And everybody went out and bought all these cars that they could barely make the payment on. They got some money from the government, and they thought, oh, look, this is probably going to continue. Why don't I just go get this loan for this car? They trade in their other car, whatever. So it caused used car prices to skyrocket. A lot of new cars you couldn't get. There were no chips. So Ford was just piling up all these cars in these yards before they could even sell them. So the used car prices went through the roof. And of course, those prices are coming tumbling down now. But a lot of people are just giving up their keys, just like what happened in the housing market in 2008. Because if you're underwater and you barely put anything down on your house, I mean, you're just going to ruin your credit. So they figured, whatever, here, take my keys. That's happening in the auto industry. A lot of smaller banks are the ones holding those auto loans, unless they have sold them off in the secondary market because other banks can buy those loans. And same thing as I explained with your balance sheet with a bank and bonds. Those bonds can get discounted, right? It's the same thing with a loan. So a bank might say, well, I don't want your $50,000 car loan at 3%. I could go make another loan right now and get 6%. So they have to discount that loan and say, okay, well, I'll sell you my $50,000 loan for whatever that number comes out to be equal. Maybe it's $38,000. So the other bank says, okay, I'll buy your $50,000 loan for $38,000. And now this person's paying them 3% interest on 50 grand. So that's how they end up working these out. But then you have a mark-to-market issue again, where that bank that sold that has to show on their balance sheet that now their assets aren't as high. Or if they're let's say, repossession, they repossess that car, they get this, let's say it's a $40,000 car. Okay, so there's a $40,000 loan. A week later, you say, nah, choke on this, and you throw your keys and I don't want this thing, and you walk away. Well, now they have this $40,000 so-called asset, depreciating asset, but so-called asset, and it's still on their balance sheet as $40,000. The question is, can they sell it for $40,000? Can the bank sell it? The bank's not a car dealership. Depends on the market, right? But in a market like this, they have to run that into an auction. And at an auction, it's not going to sell for $40,000. It's not going to sell for retail. So there's going to be some form of a loss that happens there. Okay. That initial loss, we don't know how much it's going to be, but that's going to affect a lot of the smaller banks. Now, right now, with all these repossessions happening, and I think you're going to see auction houses just overloaded with cars, which means that bank still gets to claim they have this asset on their balance sheet. They own this car. I guess technically from an accounting perspective, it probably be a fixed asset at that time because the loan's gone. That asset, it's switched with the car, right? So the balance sheet's still there. But once they sell it for 20 grand, because they can't sell it for 40, right now banks are trying to get as much as they can for these things. Boom, there's a $20,000 loss. Comes out of bank capital on the liability side, which is the owner's money. And when all that money's gone, so if you're a smaller bank, even a credit union, that bank's insolvent. Once that bank capital's gone, it's insolvent. Some banks aren't even part of the Fed system, so there might not be any bailout for them. So I would be more worried about smaller banks. So what can people do, right? One thing that like we're going to do Monday morning is I'll wire big chunks of money into my wife's Chase account, right? Because I know Chase has a ton of money in reserves right now at the Fed. I'm not as worried about them, right? So I'd move it out because I do use a local credit union, for most of my stuff. Most of it we just use for bills, and I kick out most of my money to investment stuff. I never leave it in my bank account. So when let's say you have a Schwab account, you have a credit union, and let's say you have 50 grand sitting in there. You could send that money out to your Schwab account, and it's not like a bank account. They're going to put it in a money market account. It's not affected the same way as a bank account. So you don't have to worry about it. Stick it in a money market account. Some of your banks should offer a money market account. So you could even say, yeah, I want to move that into the money market, and you should be fine. It's not a money market funds account. People get confused with these. There's a money market account and a money market fund account. One is, it's more of an investment vehicle. Okay, so I'm not talking about a money market fund, just a money market account. Call your bank, ask if they have one. You can put money in there. If you have multiple bank accounts, you can split it up between different banks. Even if you have big banks, maybe your wife or your husband has a different bank account. Maybe they have Bank of America and you have Chase, and you have over $250,000 cash sitting in there. Well, just split it so it's under the 250. The way I see it is this. I don't think I don't like how the Federal Reserve operates. I don't think it should exist, really. I get the idea of why they started it in 1913, but it should be all of us deciding what interest rates are truly going to be, not 12 people sitting around a table trying to fix market price. Think about it. Interest is the price of money. Okay. So they're trying to price set what they think money should be worth. And then you have these booms and these busts. It's created by the Fed and the government. That's where these come from. I don't care if you're Republican. I don't care if you're Democrat. To me, they're both equally worthless. It doesn't matter. They all make the best choice for their political period of time. I'll give you a perfect example. Now, Donald Trump, perfect example. If you go watch his videos before he was elected, when he was running in 2016, see what I'm about to say is going to piss off a bunch of Republicans. Okay. And I'm not a Republican. I'm not a Democrat. Okay. But here's the truth. Go watch his videos, and he nailed it. He was right on. He said, look, eventually the Fed's going to raise interest rates on some president. And when he does that, the economy is going to collapse. We have too much debt. And he went on and on and on. I think it was a CNN interview, actually. And he nailed it. That's exactly what was going to happen. That's exactly what's happening now. But then when he became president, what happened? He started saying, well, the Fed's raising interest rates. They're trying to, kill my opportunity to become president. We need to go down to zero rates. In fact, we should have negative rates, right? All of a sudden he flipped. And this is every one of these politicians. It doesn't matter, okay? When it comes to raising the debt ceiling, the Republicans do the same thing. Right now, they're not completely in power, so they're going to complain, no, we shouldn't raise it. And the Democrats are going to say, you want to kill the whole economy. And then when the Republicans in power, they're going to do the same thing. It's the same game over and over and over again. Okay. It's just used to get more power, vote me back in, yada, yada, yada. The truth is, the United States is broke. That's the truth. And if you look at what can potentially happen with the banking system, here's how you have to look at it. If you believe the government's going to do the right thing, and by right thing, I mean they're going to cut Social Security, they're going to cut Medicare, they're going to do all this type of stuff and cut government programs left and right because they spend more than they bring in. If they bring in $4.5 trillion in tax revenue, but they spend 6.5, you can't do that with your personal balance sheet and your income statement, right? Your deficit spending. That's what the government does. They deficit spend. That's why we have a huge deficit, a huge debt, because they always spend more than they take in. Where does that come from? They issue debt. They issue bonds. China buys it. Russia used to buy it. They sold them all in the market. I don't know that China's going to keep buying it either with everything that's going on. They could sell it all in the market and collapse our whole bond market. They could. They'd lose money, but they could, because like what Trump had said, hey, we're not going to pay China back after this, let's call it the virus, whatever. We're not going to pay China back. Well, I mean, would you want to lend any more money to the United States? I mean, we're just sending them IOUs anyway, right? They're sending us real stuff over here. It's crazy to think that they would even do that. But I don't think the government's going to do that. They only have a few outs. They can print money. And I think that's what they're going to do. If they're a debtor, they're going to print money. And print money means they're going to bail everything out. And you're seeing it right now. That's why there was, right before I started this, there was a news article from Yahoo that Signature Bank just got bailed out. So it looks like everybody's going to get bailed out. Another bank, Key Bank, they're not talking about it yet. I'm assuming that they're going to be one of these people on that list. And my video from this morning that I couldn't put up, I talked about what I thought was going to happen. I mean, it's happening right now. The government's going to come in, the Fed's going to come in, they're going to try to assure the market, hey, everything's good. We're going to back everything. And that it could work, but it doesn't change the actual problem. It's a merry-go-round. It's musical chairs. Okay. One thing goes wrong, we're right back where we're at. And that's why we're here today. It's the same thing that happened in 2008. It's not exactly the same, but the ideas are similar. It's a bank's balance sheet. So if you're really scared, there's a couple things you can do. And that's the money market account, move it into the big banks the too big to fail type banks, they do have a lot of cash on their balance sheet. So that's good. It's good for depositors. But that's not to say that loans aren't going to go bad or anything like that. And that resets that balance sheet lower and lower and lower. There may be buyouts. The Fed, I'm assuming right now there's all kinds of meetings going on we don't know about. And maybe another bank's forced to buy them, but no wise company would you buy your buddy's carpet business that is going out of business and you have a successful carpet business, but would you take it over if you were going to come in negative $500,000? It doesn't benefit you really at all. No, you would just be like, sorry, man, like why would I do that? It's just a complete loss. Like you're just going to have to file bankruptcy and go through the process. Well, what's going to happen with these banks is the government's going to guarantee that difference. So that bank's going to come in and say, well, whatever, I guess we have to buy them. But you guarantee that if those losses come in, the taxpayer is going to cover them. That's what you're going to end up seeing. So I think we're going to continue seeing inflation, the expansion of the currency supply. We just needed something to break. And this might be the complete pivot for the Fed, where they start pumping money back into the market. They say that they're not going to drop interest rates. They want to raise them again. I don't know if this completely changes that, but this is a very odd situation because by bailing out banks, they have to create currency. What happens with that currency? It gets into the market, into goods and services, and it pushes prices up. But if the Fed is trying to battle inflation and they don't want those prices to go up, what do? The only thing you can do is let it fail. That would be real capitalism. They let it fail. Unfortunately, what we have in our country, and it gets a bad name, capitalism gets a bad name, but what we have in our country is not capitalism. It's capitalism for you when your business fails, when you make a mistake, when you overspend, because capitalism says, hey, sorry, man, you overdid it. You got to pay the consequences. But you see, it's communism, or I guess the word technically you would use is socialism for the rich. Now, I'm not talking about the guy who has $1 million or 5 million or 10 million bucks. I'm talking about the ultra rich, big business, big bank type rich. You see, it's socialism for them. When these banks fail, your taxpayer money comes to the rescue. That you have to pay back in the future, or maybe not even you, maybe your kids, they aren't even alive type of thing, right? So unfortunately, that's just the way it is. And it's until people decide to, stick to their guns and vote certain people out, it doesn't matter. It's just the rules that exist today. And you have to learn how to play by them the best that you can. But let me see, I see there's other people in here too. I may have answered some of their questions. I see is Debbie says, is Safe Credit Union safe? I think that's kind of funny, ironic. I don't know. You might have come in late, so you might have to rewatch some of the video. I talked about it. Let's see, we're live 48 minutes in, depending on how I cut this video up. Somewhere around 40 minutes, I was talking about credit unions, and I was talking about how credit unions made a lot of small car loans. So I think that's going to be a big hit on smaller banks, smaller private banks. And they also buy these bonds, right? So all these bonds are going to mess with their balance sheet if they have to sell these bonds at a discount because now rates are higher. I do expect rates to come down because, especially with what's happening now. So we're just going to start seeing that inflation when the government comes out with these new programs. And I don't know, maybe they let it get a little worse. I used to think that the Fed was more sinister. I think how it started was, but I don't know. I think they actually believe they can make this work, and they can. They're never going to get it right. We're always going to have these huge booms and busts. So I think they'll try whatever they can, especially with elections coming up. But yeah, I'd be worried for smaller banks. I'd get money into bigger banks. And obviously, there's a lot of small banks, so not all of them are going to be affected. But it's just the panic that starts this. So initially, you see government coming out making these guarantees. No, 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 don't worry. We've got it covered. We'll back them. Your money's good with us. And unfortunately, what's really sad is all of a sudden this happens, and everybody who claims to be conservative starts saying, before this happens, we shouldn't bail out the banks until it's their money. And all of a sudden their money's in that bank. It's like, we need a bailout. Everybody wants a bailout. But that's the problem. Government has created moral hazard. That's what you call it in the economic world and finance. It's moral hazard. It's, hey, bank, you won't be punished if you go out and make these loans because we know these people have bad credit, or those people have bad credit. These teenagers, they're 18, 19 years old. They don't have any credit, but we want you to go ahead and loan them money to buy a house, and we'll back you with it. And that bank's not stupid. Okay, here you go. Give me my fee. And then the government backs that loan, or they sell it off to some other country and some mortgage-backed security they buy for their retirement plan. And the whole thing collapses in some other country's retirement plan. That's what happened in 2008. But yeah, I'd be a little worried. I'm moving my money out of my credit union. I like our little credit unions, but I can't see their balance sheet. I don't know what type of toxic assets they have. And I know the housing market's collapsing, and a local bank makes a lot of local loans. And I live in California. So I think, Sacramento is already down almost 20% in 6 months? Not even around 6 months, 20%. Like that's crazy fast. That's not even real. So I don't even know what to expect with that. I think it's possible with California, like in this area of Sacramento, I can use that number. I think we see a good 40 or 50% drop in your median home price over the next 4 years. But that's, who knows what crazy plan the government's going to do. If they keep rates where they're at, you're going to see all these problems continue with banks, with mortgages. You're going to start seeing, these people in the mortgage industry and real estate agents are going to get slaughtered. They're going to get slaughtered. This reminds me, in 2005, halfway through 2005, I went to school to be a real estate agent. And, I was really interested in it. How old was I? I don't even know. 19, something like that. Anyway, and I remember our teacher was a broker, and he came in and said, look, most of you aren't going to have jobs. We're heading into a financial crisis like you wouldn't believe. Housing is going to collapse. And I was like, what in the hell is this guy talking about? I'm not going to lose my job. I'm going to go make it, right? And I was interested. So I started digging into the economics of this. What's happening? What are these loans out there? And got some other message on here. I realized in 2006, this is going to happen. Oh my gosh. And then I read Rich Dad, Poor Dad, and I started seeing Robert Kiyosaki on the news. And I was trying to tell family, don't buy a house. It's over. And they're saying, oh, I got discounts from the builder, which you're seeing the same thing today. You get the discounts from the builder, or in this case, they're buying down your rate. So you go to buy a home, rates are at, gosh, I think they're at like 7% or something right now, right around there, right? And let's say home prices got to $500,000, right? And someone can afford X payment on that house at 3% interest. But if it goes to 7% interest, their payment doubles. They can't afford it anymore. So what you're going to see, as long as rates stay where they're at, people buy a house based on a payment. It's just like a car. They don't care. They don't care if it's $50 million, if it's like 0.25% interest, and they can make that payment. That's how they buy a house. So if your mortgage rate is 7%, what does that price have to fall to reach that payment you could afford? That's what's going to happen. Home prices have to fall there. So El Dorado Hills, California, perfect example. That's where I live. And the median home price here was $1.1 million, right? That was almost a year ago, not even a year ago. And today it's fallen a lot. I think it's in the high 700s or 8, somewhere around there. But I could do the math and say, okay, at $1.1 million, that was the peak of the market here in the specific area. I can look at the market and say, okay, it was 3% interest. That would have been the loan they would have been getting. So what does that payment come to? And I could do the math. You pull up a calculator online and you could see that payment. Say, okay, well, that was pushing everybody's budget around there. That was kind of maxing them out. So probably a little bit under that is a realistic range where the people in this area could afford that payment. But if the interest rate goes to 7%, I just have to find that same payment number. That same payment number comes out, I think at like 6%. It came out to around 650,000. That means the median home price in El Dorado Hills, California has to fall to 650,000 to have the same equivalent payment. So it's going to go there unless they start dropping rates, which I think they're going to. But in 2008, when they did that, they dropped rates to the floor. Housing still collapsed. It collapsed for 5 years. It didn't even bottom until 2012, even though interest rates were zero. Yeah, I mean, your mortgage wasn't zero. They have to make some money on it, but that's what happened. So I don't know that that same exact thing happens this time. Maybe they drop rates and people come flying back in, but they're not going to if the banking system's having all these issues, or maybe banks don't want to lend at that point because they don't know if you're going to be able to pay them back. We're in a recession. No matter what anybody says, we're in a recession. We've hit every main point that would be considered a recession. Until the government says we're in a recession, they assume we're not. We're there. The yield curve is inverted. That means, why is it you can get a 2-year treasury at 5%, but a 30-year is, I don't know, 3.5%? Like, why would you lend your money to the government for 30 years at 3.5% when you could buy a 2-year treasury and get 5? What that tells you is the market sees a lot of short-term risk, so they're willing to sell certain treasuries, and that's pushing those rates up. And finally, someone sees that interest rate and they say, yeah, I'll pay that much. I'll take that. And they'll jump into it. But that the yield curve is inverted when you have a 30-year treasury with a lower rate, because you have usually a risk premium. The shorter the loan, it's less interest because there's less risk. It's the time value of money. So the longer the loan, the more the risk. So the interest rate should be higher. So the question really people should be asking is, how come the market doesn't see a problem in the future, right? I think you're more likely to see a long-term debt issue where the 30-year spikes, and that'll set the market back in its equilibrium, but it's going to be painful. So I don't know. We'll see what happens. But if there's any other questions, I see Joseph in here. Joseph, I'm going to bring you in. As soon as I click on you, you're going to pop up. So if you got a question, I can't see. You could text in the private chat right now if you have a question. If you don't have a question, just let me know. Hey, don't click on me. I'm just hanging out in here. Otherwise, you're going live, man. Boom. What's up, man?
Hey, man, can you hear me?
Yeah, I got you.
Wow, okay, that's pretty cool.
What's up?
Yeah, so I'm getting into the space of like acquiring Airbnbs the pre-foreclosure route. Do you think it's coming up to be a great time to be doing that with what's happening with the banks?
Yeah, pre-foreclosure for sure. I mean, that's what I tried to post a video, I don't know, a year and a half ago to real estate agents, just saying like, hey, you're going to get killed. But they don't see it. And unfortunately, I think it has to do with that's where their money comes from. Nobody wants to believe that's going to be the case. And what I was telling them to do is start learning how to do short sales, talk to the people that were at Keller Williams in 2008, right? Talk to them and say, hey, how does this work? How do short sales work? Can you kind of train me on that? How do bank-owned properties work? Those are the agents that are going to thrive. The newer people, they won't know what they're doing. They're going to drop out like crazy. But yeah, the pre-foreclosure market, I think that's going to explode. There's like, I think over 8 million homes right now that's, since, I think it was since COVID, I think banks have to start reporting it like last March or April or something like that. It's been almost a year, but they're starting to report them, and there's a heck of a lot of homes that are going to be coming onto the market. And I think last year, I'm not sure the exact number, but 25% of all homes I think that were bought last year were bought by investors, small time investors,
Mhm.
probably single family homes. And when you hear people say, yeah, but there's low supply, it's bull crap. It's bull crap because they're not counting the supply from those investors that's just sitting there. And it's going to come flying onto the market super fast. And all of a sudden that supply just explodes. And right now, even though there's a low supply, you're seeing home prices drop. How does that happen if there's low supply in your area? It doesn't work that way, right? Prices would be stabilized. That wouldn't be an issue. No, it's telling you that there is more supply than there are buyers at this point. And right now you're seeing real estate agents, they're waiting for the spring because that's when people buy. And I've never really even understood that. Because if you're a buyer, I mean, just think of the concept of that. If you're a buyer, wouldn't you want to buy when it's cheaper? I'd want to buy.
Mhm.
And if you're a seller, why would you want to wait till the spring when supposedly all these other sellers are going to list? You want to list your home when it's low supply. Like, it doesn't even make any sense. But yeah, I think there's opportunity there. But what I would be worried about on the Airbnb side, because your main expense, I mean, assuming you buy a home, if you're hacking where you're renting the home from somebody, like their mortgage or whatever they're going to charge is $2,000 a month, and you say, hey man, I'll sign the 1-year lease if you allow me to run short-term rentals out of it. And they say, whatever, man, as long as you pay me $2,000 a month, I don't even care. Then, and you can make cash flow on that. That's great. If you're buying the homes, that's where it gets tricky in this type of market. It just comes down to, can you service that debt and make X amount of income on it? But I think a lot of people who are doing Airbnb, they overpaid because, I mean, think about this. Airbnb, you can make a lot of money. And let's use Florida, for example. That's a great market. So let's say Tampa, Florida, you buy some house for $300,000 and you could rent it for, let's say, $3,000 a month, that's the 1% rule, right? 1% of what you bought it for, you can rent it for. That's great. But some dude comes in from Airbnb and he's like, yeah, but I can rent this out all the time, make $5,000 a month. So they're willing to overpay a normal investor who looks at that and says, yeah, $3,000, that'll cash flow X amount. I'll go ahead and buy this. And you come in and you're like, nah, I'll pay $375. And they're like, what? This guy's crazy, but you're going to make $5,000 a month. So you don't care. You're going to get the property. But a lot of people did that. And now when you're not seeing as much travel and people are going to be hurting during a recession, what's going to happen to that business? A lot of those business models are going to collapse. The people who, bought years ago or something, they have lower debt service. I mean, they'll be fine. But the other good thing for you then is those other Airbnbers that the market kind of collapses on, they overpaid for the house thinking, I'll beat out the rental market. I'm going to make more money anyway. Well, when there's less people coming around, the supply, think about it this way, the supply of Airbnbers starts to disappear, which means as long as you can hang in the market, that market's going to find equilibrium. Yes, there's less people traveling if they're hurting financially, but there's also less Airbnbs. And as long as you're still in the game, you're just going to absorb that market.
I think it all just depends on the type of customers you're trying to get on Airbnb. Like, I have one property in Davis where we started renting by the room because we were noticing through the data, oh wow, there's a lot of people that are like listing just rooms in their houses, and they're making pretty well. And so now each room makes about $2,500 a month, on average throughout the year. And it's just people that are visiting the University of Davis for whatever reason, whether it's a professor or it's parents or it's a potential student or someone's just there briefly. And so, yeah, like we would not be making that kind of money if we were renting the entire house. But, we switched over to meet this new demand by looking at the data.
Yeah, and see, the thing is, even if there's less people, if your spread is that high, right? Even if there's less people traveling, you can take that hit. If there's, even if you own it, right? Let's say you're not hacking, you buy it, you own it, you got a mortgage on it, whatever. Even if you're not hacking, let's say your mortgage is 3,500 a month, you're making 7,500 a month. Even if it drops to 5,000, you're still cash flowing, right? So you're going to be okay in that situation. So I think that's market driven. Like, you found that specific area that's going to work out, and a lot of people aren't, in that specific area that it's going to work out. They're going to get crushed, but it's less competition for you.
Yeah, and then I have another property in West Sac. It's not been doing well on Airbnb just due to like the cleaning fees just taking too much of the cost. Because for the West Sac one, the mortgage is 3,000 versus Davis, it's 1,600, and so I've had to switch over to travel nurse for each room. And so
Oh,
even
really?
though
That's good.
the gross is less, the margin is more because like I'm not having to clean it every other week.
Yeah, less turnover. That's good. Travel nurses make good money. So that's a great way to play that.
A
Yeah.
quick question for you. Are you familiar with Subject 2 when it comes to creative finance?
Yeah. Like, it's sort of like, I think it's sort of like a wraparound mortgage in a way. Like, if I owed, if I owed a bank $100,000 and I can fix a house up, do a little bit of work or whatever, maybe didn't need a lot of work, but I can create $130,000 in total value. So there's $30,000 spread on what I owe. Instead of selling the house the normal way, you come along, maybe you're renting from me, whatever, and maybe your credit's bad, but you have cash. Maybe you still make good money, but you blew your credit on a car or something. Then I might say, hey man, I'll sell you this house for $130,000 and I'll hold the note. It means I'll write you a mortgage between me and you. And maybe my mortgage with the bank, let's say, is at 3%. And then I do a personal loan with you, or a personal mortgage. It's still, that asset is the house at 4% for 130 grand. Well, then I'm making a 1% spread on that $100,000. I just created money out of thin air that didn't even exist. And then the 30,000, maybe I don't even have the loan for you with 30,000. Maybe you give me 20 grand down and I get cash right now, right? And you owe me 110 grand at 4%. I'm making 4% on 10 grand, and I'm making 1% on 100 grand that I owe the bank. And as long as I'm making that payment, I'm good. And some banks have an accelerated clause that they don't always enact, but where they could come to me and say, hey, you got to close our loan out right now. So that could happen. But yeah, there's a really good guy who does all the Subject 2 stuff, acquires all kinds. I can't remember his name. It's on YouTube.
Oh, does Case Morby ring a bell?
I'd have to see his face.
Okay, well,
But
that's the guy on YouTube I've been watching, and like, so that's what my friend and I were trying to get our first Subject 2 deal through pre-foreclosure. So trying to find someone that, yeah, they don't want their credit to get ruined, they don't want to have it show up on their credit report, and so yeah, we basically give them like, let's say, $10,000, and then we just take over the mortgage payments. And so yeah,
yeah,
right now we've been cold calling every day, trying to find someone like that.
yeah, it's probably that guy. I've heard him talk about where someone had asked him a question about the acceleration clause, and he said, look, dude, what I do is I buy, I guess there's acceleration clause insurance or something like that. So he'll go buy insurance for it in case it does happen. It wipes out the loan and they're good to go. But he said it's super rare that they don't care. As long as they're getting paid, they're like, whatever, just make my payment. So yeah, that's a really cool strategy.
And what you had mentioned earlier, he calls it just like a wrap. But the other case is like, it's basically you're trying to find people where it could either be pre-foreclosure, or it could just be someone like they're really insistent that like, hey, I need to get my asking price. And so with creative finance, you can say, hey, I'll agree to your asking price, but on terms. And then, so
Yeah.
if someone's willing to do that, like let's say an expired listing on Zillow, they were wanting to get it at 600,000. You're like, hey, I'll pay that. Just let me, do it, either through seller financing or Subject 2. And so, yeah, so I'm in his course right now trying to learn how to do it.
Yeah, those are super interesting deals. We're actually, the reason we were in Tahoe, we wanted to show my son how much snow there was, but there's a
Mhm.
property we're looking at there, and we sent out a letter of intent to buy. It's a hotel in that area, South Lake Tahoe, and hopefully we can get this place. We'll see, but we're using creative financing because I talked to Chase and they won't loan on hotels unless it's a flagship hotel. You know, there's a Motel 6, someone selling 50% of their interest for that. And I'm curious because they want like 10 million for that. So I don't know what that cap rate is. I think it's around 5% or something. But anyway,
Is it on the main
um,
strip?
yeah, dude, if
Um,
we can make this work, it'd be amazing. But they can't sell it to anybody. It's been completely closed down. I mean, it's going to be a ton of work. I don't know for sure if it's worth it, but I talked to Chase and they gave us some good strategies, other lenders that we might be able to work with, but they gave a lot of information on how we can make that work. So we're going to try and work with the guy on owner financing. If he'll owner finance the property and the building, needs complete remodel. The whole place has to be ripped apart. But if he'll owner finance that side of it and he'll maintain second position as a mortgage, he don't care. He's losing money. He's bleeding money. The county's finding him. The city's finding him. He's bleeding money. So for him, unless he's able to take that loss, and he's like, whatever, I have other properties. I need the loss. I don't know. We'll see. But if we have him hold that, you usually have to get different loans when you get into the commercial side. Like I work in the commercial world with multifamily housing, and you might need a loan for the building. You might need a loan for the remodel. You could do these green energy type loans. So they're all different types of loans. You have to get into like 3-4 loans to make the deal work. But that's how they end up doing it. But super interesting. Creative financing is really the way to go if you can do it. Depends on where you're at or the deal.
So, funny story is, I think we're going after the same lodge because I'm about to put an offer for a lodge. It's like 25 bedroom. That's on the same main
Nah,
strip.
it's different. This one's 72.
Oh,
It's
72.
different.
Okay, gotcha.
Yeah.
So yeah, so I used Property Radar, and it showed me that this lodge was 2 months behind on their mortgage, and so yeah, I like skip traced, found the owner, and so yeah, I'm trying to build rapport and yeah, do seller financing. They were wanting 2.2 million. Someone offered 1.85. The deal was going through. The lender said, "Hey, you need to remove everybody that's staying at the lodge." So the lodge has been vacant, and then I guess last week the lawyer told me that the deal fell through, and
Yeah,
so
because they're doing longer term rentals there to some people because they struggle. Like from what I saw in that area, I think it's a 30%. I think it's 30% booked generally on average throughout the year, which really isn't a lot. But
well, this particular lodge, I don't know how they've been even getting business because their website has been down for 7 years. So like they've been just getting people that are just driving by. And so like since it's in the commercial
pretty
zone,
good.
I could put those rooms on Airbnb and quickly have a good turnaround.
Yeah. Well, let me get to some other questions. Good questions, man.
All right. Thanks, man.
I'll pull you off the screen, but you're still in here.
Sounds good.
All right. All right. I see another one here. Hold on. What does it say? Is there a time schedule for FDIC, e.g., does it take a couple of weeks or a couple of years to get your insurance deposit back? I'm not exactly sure, but I know with this Silicon Valley Bank, supposedly it's going to be there Monday and good to go, unless you had over the $250,000, which at that point, well, actually, they're getting a whole bailout. So even those depositors are supposed to be fine now. But otherwise, those depositors would have got part of whatever assets they sell, buildings, anything they have, computers that they end up liquidating, assuming they don't get bought out or something before they got the bailout. And maybe they'll get bought out. I don't know. If the government guarantees the bank that's buying them out, then maybe that's the case. But I know ownership would be wiped out. Stockholders, they're going to be wiped out. Lenders who lend to the bank, like actual loans, they would be wiped out. And that would be part of the deal for a bank to buy it, right? Another bank might look at them and say, well, like, where are they going to get their profit? They need something. So if the Fed's going to tell them, hey, you just buy this bank and they got to cover all the deposits, then their negotiation might be, okay, owner equity wiped out. They get nothing. All these loans that are sitting here, this bank owns to or owes to this bank or owes to that bank or owes to these owners or whoever, private financing, whatever, those are wiped out. We want this stock that we owe these people, they're wiped out. We'll cover the depositors, and that's their win. So, and it depends. Maybe their risk profile for the new bank isn't what they like. Like this bank loaned to a lot of startups. Maybe they had to go to these banks for startups because they were willing to take more risk, and maybe Chase isn't willing to take that much risk on it. So they want a discount even on those deposits, which then maybe the government would come in and say, look, we'll back X amount of deposits, just do the deal, which means your tax money. But yeah, I'll have to look into the 10% thing. There's something about 10% in the fine print or something someone brought up, that they only have to pay 10% of the actual 250. But again, I wouldn't trust the FDIC anyway in a massive banking crisis because they have to get their money from the government. And yeah, you get your money, but what's it going to be worth if every bank in the United States would be failing? Probably nothing, or there'd be massive inflation because they have to print the money and you're just going to buy less with it at that point. Let me click on another one. Oh, and if you haven't found, go YouTube. There's a video, I think it was leaked in November, the FDIC. They're talking about this stuff and how they weren't going to tell private people what was going to happen in the banking system. I don't know if it was a war game type thing, but the guy literally sitting at the table says, man, if people knew how banks really worked, luckily we know here. But if they knew how they really worked, they'd pull all their money out tomorrow or whatever. He said something along those lines, and talking about how private capital professionals will get their money out. And then right before this happened, venture capitalists, they were sending emails out to small startups saying, hey, get your money out of any small bank you can. This is the real deal. Get it out right now because you got to make payroll and all of this. So I expect there to be more and more draws. I don't think they're going to trust. I wouldn't trust it, right? If I had a small tech startup and I was in one of these banks, you got to make payroll. I'd be wire transferring that money to JP Morgan Chase or a big bank that I know, hey, they're more likely to be covered here. They're probably going to be the ones that buy out the bank that I just left. But hold on. See something else popping up here. First car is now $50 today at the rate. $1,000 a month for that car. Average loan. Careful in California. Hotels in California have been forcing. Oh, this isn't a question. But yeah, the eviction thing you're talking about already happened. See, in El Dorado County, here's the thing. El Dorado County in California is the best county to be in. Now, we lost our really good sheriff that we had. He retired, but we got another good one there, and they do evict. So it's already closed down. Everybody's been evicted out of there. It's trashed. It needs a lot of work, but that's where the value is going to end up being. What I'd be more worried about in California are the regulations and all that type of junk. But this would probably end up being a flip deal down the road. I don't really know, but if we can make the physical asset work, it would still be profitable. So anyway, who else have we got in here? Let me click over to the Facebook. I see the YouTube one here. And looks like that's it in my StreamYard questions. I know you guys can't see those ones. But let me click over here just in case. Okay, yeah, no other StreamYard questions. Anyway, if there's no other questions, I hope I explained it. I know people were jumping in and out of here. I know some people lost connection, came back. If you missed something, I'll post this video on YouTube. It might be automatic after this, and you can rewatch some of it back. I talked a lot about how the balance sheet actually works with these banks, how the currency is created through the banking system, and bonds, how this bank was holding some of these bonds and they get discounted on the market. When you come to pull your money out, they have to discount those bonds, and now it's a realized loss. And once you have a realized loss, it's reflected on the balance sheet. Then your financial report comes out for the bank, and it's, they don't have enough assets to cover liabilities. Bank capital's wiped out, and poof, that bank goes down. So that's going to be interesting. I don't know if tomorrow is going to be a Black Monday or something like a 1987 type crisis. I don't see why people would freak out and start selling their other stock, even though I think the stock market's still overvalued. It should sell off anyway. Hold on, I have something coming in here. So they are talking about special vehicles in case. What's this say? They're talking about a special vehicle in case of a bank run this week. Yeah, right here, Toyota Beast is talking about this. Yeah, I mean, probably as I've been talking about this, there's probably been news article after news article coming out of something new. But I wish I could have got my video out this morning. I talked about all this, that the Fed is behind closed doors right now, government, they're trying to figure something out. And it's funny how fast they switch, where it was, oh, no, we're not going to do anything. Just Friday, I think, Jerome Powell and I think Janet Yellen or something yesterday had said, like, nope, they're on their own, and everything changes, right? So that's what makes me think it's not necessarily sinister. Look, here's really what it comes down to. They either don't know what they're doing or they're liars. That's all it comes down to. And even, from the intelligence world, from the military, I mean, they know things you don't know. And they have to lie on the news about what's happening because they think they're going to keep panic from happening. So the Fed or the Treasury comes out and does the same type of thing. It's damage control. If we can just say this, maybe it won't happen. And I don't know, they'll probably convince people that it's not going to happen. They'll come out and save the day. I think people are so pissed off about what's happened over time that the banks get the bailouts. And what about them? During COVID, finally, they got their bailout, which really were just destroying our kids' future. So, I mean, we got robbed through Social Security, right? People my age, we're never going to see Social Security. And if we do, I don't know what it's going to buy me. A cup of coffee, maybe $2,000 for a gallon of milk or something by then. Who knows? But matter of fact, there's a video you can look up. I don't know the title of it, but there's a congressman or a senator, someone in what was the banking committee, but he's on the floor talking about saying, look, we will always pay Social Security. Just might not buy him anything. That means they're going to print money to do it. So I still fall on the side throughout this video. If you go back and you watch it, if you missed it, I fall on the side that it's the path of least resistance is what government's going to do. And least resistance initially, in the short term, they're going to print money. I think that's what they're going to do. They'll eventually lower rates. First, they'll try to back the market. Then when that doesn't work, they'll try to lower rates, which is going to cause expansionary monetary policy, which is going to, have inflation take off. Well, the inflation is expansion of the money supply. Keep that in mind because all you're going to hear on the news is inflation is rising prices. That's a symptom of inflation. It is not the root cause of inflation. So anyway, what else? There's a link here. You've seen this coming. FDIC has a meeting with the bankers back in November. Yeah, that's what I was mentioning. There's that video on YouTube I mentioned earlier on. Go Google that. It's kind of crazy, but someone leaked it. Any other questions from YouTube? Or I see some come in on YouTube. Some came in on Facebook. I have no more inside of the Yardi stream. Some people came in, or Yardi. Oh my gosh, I'm in property management, so I deal with their software. Any questions for me? Let me click back over here. Okay. So this is an hour and 24 minutes. Even if I edit this video, it'll probably be somewhere still around an hour. So if you missed a lot, just rewatch the first half of the video. I probably covered that. And maybe I'll do some more like this, but I'll cut them down to like a, I don't know, 20 or 30 minute thing. I'll have specific questions. Maybe I'll have people send me question lists or something in the future. It's a little easier because I don't really have to edit this video much. I kind of just wanted to post and let it run. But anyway, if no other questions come up in the next few seconds, I'm going to kill this thing. thanks for coming on and asking your questions, by the way. Hopefully I answered some of those. I know some of them got into the investment stuff, still interesting things, but maybe I'll do one of these for personal finance or something. I see some people are dropping out in 5, 4, 3, 2, 1. All right, ending broadcast.